So basically, up to last week, actually, we have discussed about non-financial tools in detail with some examples and case studies. So I also invited you to do some similar kind of exercises. They are probable, the examination questions. But as I told you on the other day, it's very rare that we will get sort of those questions, because now so far we have not got that kind of questions for the paper. But let's say, like, brief description, detail description, compare and contrast between models. So those things could be very much possible. So that's what the maximum we can expect in terms of non-financial tools. So today we are trying to understand more onto the financial statement and ratio. Now, in this perspective, actually, now, if it is like an existing business, yes, it's very much vital for us to understand how the business is performing in terms of financially, because it's like ongoing. And so we try to understand from last year to this year, and then so next year, like that. So we try to understand how the financial numbers are moving on, the financial numbers are taking place. But in case of a project, the importance of the historical financial may not exactly or may not be very much important. But if you think about a company who is coming to start a project afresh, where it has been doing some other business, then again we need to know about the financial statement and the ratio analysis. So in that context, so I think this is important. On the other hand, like if it is a new project, startup and all that, then what we need to know is not the historical financial, need to know more about forecasted financial statements. So that is basically will be something about forecasting, which is another sort of a session that which we are planning to understand. So just to create a kind of the difference between historical and the projected financial. Historical is very much important in terms of existing running business, and forecasting is important for a company who is like trying to do a fresh project, right? But even to understand the forecasted financials, we need to know the ratios, right? So what are the the financial statements? Because when you say forecasted, again we talk about P&L, balance sheet and cash flows, right? Historical, yes, P&L, balance sheet, cash flows. Generally we have three sets of time horizons, like historical, current, maybe the management, and the other one could be the futuristic. So historical, management, forecast. There are three things that we need to learn, but today that we're trying to focus maybe current and the historical perspective analysis. That's one. Number two, now whatever said and done, when you are talking about project viability, project feasibility, we need to understand several feasibilities, not only the financial. Like what we did in the last week, we discussed several non-financial tools which support us to understand the other feasibilities, other viabilities, right? Example, marketing, management, maybe technical, maybe what do you call legal, environmental, right? So those things also to support for the project implementation, right? Financial is one. There are several other feasibilities which we learn through different mechanisms, right? So through non-financial tools, because let's say marketing feasibility should be there in order to understand the financial feasibility, what it's meant. Let's say now, as we discussed last week, if the highly competitive market, probably we don't see a potential to launch a project or launch a new product or service. So then our financial assumptions, our financial forecasts depend on your marketing plan. How much you are going to sell, what are the type of markets, what are the pricing, what are the the marketing strategies, and everything is useful to understand the turnover or the financial targets. Hope you are getting it, right? So basically all other things also important when learning the financial analysis, financial evaluation, right? When you say marketing, what we just discussed. When you think about technical, for example, say capacity of the machine, skill level, after sales service, availability of raw material, say infrastructure and other related cost, and everything is important because the success of the technicality of the project, technical operation in the project will tell you how much you can, produce at a given time. Then that will be that you can sell or whatever those things, then you get the turnover, right? So then once you have the turnover, you will have all the other ratios and parameters. But in order to have the financial data, have the financial numbers, there are other feasibilities also to be there. So when you are learning this, we need to understand financial statement and ratio analysis is one of the things that we need to understand in terms of project financing, that support us to understand the financial feasibility. There are some other feasibilities which we, just learned some tools last couple of weeks. And then the combination of those things will be useful in understanding the total project appraisal, project viability, project feasibility, whatever we name it. So that's what our plan is. So we try to understand the total project cycle and project evaluation and project appraisal by learning different aspects which supports it. So financial analysis, financial feasibility, financial ratio are very much important and part of the total appraisal or the evaluation picture. So having said that, now we plan to start, since most of you have joined. So any questions before understanding about this? What I just discussed, anything that you need to link it up, bridge it up, any gray areas? Presume most of you have done something about financial statement analysis sometime in your career, in your academic career, because this actually has been, applicable in many of the syllabus areas, right? So I think it's not a big deal, but just we try to understand some concepts, and so we try to start this from the beginning. Okay. Two concepts, right? Financial performance and financial position. I know this has been learned in different way. You have learned this in many other occasions, but just as another way of looking this P&L and balance sheet. When you say performance, it talks about P&L. When you talk about position, it talks about balance sheet. So that's how this slide is going to interpret those two statements. Say assets minus liability is equal to the book value of a firm, right? So assets, right, that part, the current assets and permanent fixed assets. So the total assets minus the liabilities is current liabilities and long-term liabilities. So assets minus liability gives you a kind of some idea. So that will be the value of the firm, right? So that's what basically, funded by the client equity, client capital. So those items are represented in a balance sheet of a firm, right? Then revenue minus expenses. So revenue, I mean income, less expenditure gives you a figure which we call net income, right? Or rather, it is the the performance of a firm. So in other words, it's a profit and loss accounts, right? So you can either way. See, this the performance and the position, which is the P&L and the balance sheet in other way, right? But here, try to understand position is basically assets minus liabilities. Performance is like revenue minus expenditure. Okay. If you have any questions, you can raise it, right? So this is very important slide because sometimes examiner might question us on listing the key financial statements, brief description of a financial statement. So if that particular question is given to us, so we need to know this slide. So these 1, 2, 3, 4 very important. You can put a tick mark also. And the kind of description that to be memorized in case the examiner would when question us on these 4 areas, right? The balance sheet is the financial position of the firm. What are the ingredients and what are the components, asset, liability on a particular date. Also, you can give some examples like, say, fixed assets, debtor balances, long-term loans, right? Are maybe like intangible assets, right? Are part of the items in the balance sheet. So if the examiner asks that particular question, what you need to write is what is balance sheet, what are the main, like, the classification, asset, liability, and give some examples. So that's much better here that I haven't included any examples, but when you are writing the answer, so you can include the examples also, which gives a better and complete answer. Then income or earning statement. What is that? Income or earning statements. So that is basically, like earlier I was telling, that's the output of a company's operations. That is, the items like revenue, expenses, the profitability, taxation, financial expenses. Those are the components. Also, that you can name some few items in the profit and loss account. So basically, income earning statements gives us the results of the operations. That's more or less like per a particular period. The balance sheet on a given date. Then third one, stockholders' equity, shareholders' equity, reconciles the beginning and the ending balances of all accounts that appear in the stockholders' equity section of the balance sheet. So there's a net worth or the stockholders' equity area where what should be the opening balance and what could be the profitability or the retained earnings that you have carried forward, and what could be the closing balance. So that ultimately tells you the value for the stakeholders, the net worth of the firm, right? So every stakeholder, every shareholder wanted to increase the net worth. So that's what generally, the objective of those shareholders for their investment. So we need to maintain it in a good shape, right? Because with that, we can, retain the existing shareholders, and we can, attract the new shareholders in case if we are going to kind of a public, for example. Then fourth one, cash flow. It provides information about the cash inflows and outflows from operating, financing, investing activities during a given period. So it basically gives you an understanding what is my operating activities cash flows, what is my investing activities, what is my financing activities. What is operating activities? This is more or less working capital related expenses. When you say financing, it's a debt servicing like capital and interest and charges, so finance charges payments. Investing, your investments in fixed assets of the firm. So there are 3 separate items in a cash flow, right? Operating cash flows, financing cash flows, and investing cash flows. Those 3 are very much important in terms of cash flow, in terms of cash flow statement. So these 4 are very important. You need to list them, briefly describe with examples. So that could be a possible question in terms of exam. So up to now, what the examiner could give us is, probably he might ask about what is the advantage or importance of financial statement or ratios. What do you understand by the financial statement and ratios? List the financial statements that you are commonly involved with. Briefly describe the financial statement. So those are the type of questions that he can produce us in a the area that we have been so far understanding or so far learning. So any questions up to now? Right. Then we try to move about statement analysis, right? So yes, we have so many statements that we just spoke of, but importance is how we are going to analyze those statements. So what I am telling is, let's say now in absolute perspective, if somebody comes and tell you, I am a 5 billion, rupee company, or I am a maybe $100 million company. So do you find anything out of that? What do you understand by that? Is it a meaningful information to you? Any thoughts? Ravi, what do you think? When somebody come and tells you, I am a 5 billion rupee company, what do you think? Is it valuable information to you?
Yes, sir.
What do you mean?
It's a profit, annual profit. Might be the
No,
annual.
let's say turnover. I'm a
Yeah,
5 billion turnover company.
every
So,
turnover.
yeah, is it like meaningful to you
Yes,
without any other information?
yes. So we can see whether it's a large company or SME or a SME or something like that.
Right. So when you say SMU larger the company, what do you think? You want some more other information also, right? Otherwise, you don't know whether it's SMU large or whatever.
It's
Maybe you
just a
need
one.
to,
It's a just a one requirement.
yeah, it's just another information, right? Right. But if now they the same company come in and tell you and say, so I am a 5 billion rupee company, compared to last year, so I have grown from 10 to 15% from last year to this year. Is it a meaningful information now?
Yes,
Yes. And then
exactly.
somebody would again come and telling, industry average for the last year for our sector is something 4 billion, but I have recorded 5 billion turnover during the last year. Is it meaningful?
Yes,
Yes. So what basically we are interested here. So we always try to compare with another piece of information, especially in terms of financial statement analysis, because last year to this year, industry trend to a particular company turnover, or maybe competitor to your company turnover, or maybe within the financial statement, or where how like the composition to expenses to the turnover kind of thing. So always we try to compare it. So then only these information are valuable. Otherwise, if I come and say, so I am 5 billion, so I must say very good, right, good performance and all that. But when you inquire about other companies, peers, competitors, industry, so everybody records something like 10 billion, 15 billion. So then when you compare with that, the turnover and numbers, it's not exactly that you are happy of, right? Because average is 15, but your company now we are coming and telling 5 billion. It's a below par performance. But if the industry is 1 billion, 2 billion, 3 billion, you are doing 5 billion, it's a great achievement. So basically, we need to have some tools when we analyze these financial statements. Then only we have a value there. Otherwise, we don't have meaningful financial information, data. That's what our discussion here. So there are a couple of methods that we can evaluate financial statements. We sometimes call them as financial tools in financial statement analysis. So what the first one is comparison across time. That is last year, previous year, this year. So we have maybe 2-3 year data. Comparison over time. So maybe turnover in year 1 we have 100 billion, year 2 120, year 3 maybe 140. So you see a gradual increase over time. We can compare this year turnover with the last year or previous year, whether we have seen a growth or not. So it is called a comparison over time. Very important tool where you will compare your top line, middle line, bottom lines compared to previous years and the current performance. That's the first one, first tool. Then we have another tool, comparison with industry, where in the same industry there are several other players, say advertising companies, pharmaceutical companies, supermarkets, maybe tea factories. There are several other companies operating in the industry. And then we try to compare industry numbers with the particular company's operations. That is called industry or the trend sort of analysis. Right? Let's say current ratio, for example. So current ratio, generally we say 1.5 times, quick ratio 1 times. That's a general understanding. But let's say if you are in a company where the current ratio is on average, the peer competitor is about 2 times or 2.5 times. Then you have to see what is your current account, current ratio. So if you also in 2.2, 2.3, 2.5 times, then we say it's a equal performance with the industry peers. So that's what we need to understand here. Because now say 2.5 times is very great compared to general that is 1 and 1.5 times. You can't, be happy. You have to, compare with industry data because those are the similar people that you need to compare. Because otherwise I'm saying I'm very happy about 2 times current ratio, but the industry average is 2.5. Means that you are not with the like par with the industry players. Then the last one, within the financial statement, we call common size or vertical analysis. So that basically, let's say you take your sales as a base, maybe 100. And as a percentage of sales in a P&L, what is my other components related? Expenses to sales, financial expenses to sale, GP to sales, OP to sales, NP to sales, right? So is a particular year and you see a percentage of each items with respect to sales, say year 1. You go to year 2, you go to year 3, you do the same exercise as of sales. How much is my expenses? Then it gives another indication. Example, year 1, GP to sales will say 10%. Year 2, it has become 8%. Year 3, it has become 7%. What it meant? GP has come down, right? So GP is basically cost of sales, like sales minus cost of sales. So the figure is now, let's say it's more or less coming down kind of thing. So then ratio is, it's one of the reasons, right? So maybe the ratio is decreasing. GP margin decreasing technically. So how you see the particular year and you compare the same set of equation for year 2 and year 3. Probably due to some issue in the efficiencies. But in vice versa, if the GP margin is going to increase 10, 11, 12, 13, so means that your efficiencies has been increased due to learning curve, due to new machines, due to new layouts, right? So it gives some understanding about within the financial, before you go into the competitors, go into the market, industry, you try to do your own within the financial statement we call vertical analysis. So basically, you can do it across over time. You can do it across industries. You can do your analysis within the financial statements. Those are the 3 tools. The final one, basically, though I am not, specifically taken as a tool, but in the next slides that we are discussing that, it's a ratio analysis. So there are 4: horizontal analysis, vertical analysis, trend or industry analysis, ratio analysis. 4 financial tools being used to evaluate financial statement in the firm. What are the four? Horizontal, that's over time. Vertical, common size within the financial statement. Trend with industry. Fourth one, it's a ratio that we are going to discuss in a little while. So again, we may have used some ratios in all those, the previous three analyses, but you can take it separately also. Ratio analysis is also one of the very important tool in analyzing the financial statements. Right. Any questions up to now? I think we have discussed very important information, not only for our knowledge and for examination purposes as well. Any questions come across? It's up to you before we start the next one. Okay. This is the example for common size income statement, right? We talk about vertical analysis. This is how basically it's going to do. Here on this company, 2000, we have data 2010 and 2009, right? So what we have done here is we have taken sales as base here 100%. And then as a percentage of sales, you try to do the cost of goods sold. So in this year, 2009, 81.83, 83.33. Then GP 18 has come down to 16, like that. So you can do analysis on each item in the P&L for each year. So what you can do is in 2009, if you go the vertical analysis here, net income as a percentage of sales is 3.68. And when come 2010, it has come down to 1.9. So rather than going to industry, rather than comparing last year to this year in terms of absolute numbers, now you have a better number in terms of relative ratio as a percentage of sales, right? In terms of actual numbers also, you see 85 million has come down to 49, right? But it's betterly shown in terms of, sorry, net income 128 has come down to 74. Its absolute perspective, it also has come down. And again, if you relatively see 3.68 has come down to 1.9, almost maybe 70% kind of a drop. So it basically gives you a better view than looking at the absolute number and doing the computation. Ratios and all that you can compute. But before doing that, when you have the common size statement, it's readily displayed. You can see it very easily. So similarly, you have common size balance sheet, right? So it's in a larger view, right? This is the common size balance sheet. Because why we have done this? Because we need these data in order to compute the rest of the computation presentation. So that's why basically it has been shown like this, right? So here in a common size balance sheet, we have taken assets, we have taken liabilities and owner's equity as a base, as 100. And then based on that, we have taken each asset and liability, I mean, balance sheet item percentage. Then we see what is the like change. If you take cash in 2009, it's around 4%. Now it's come to 3%. So we can see a drop in terms of cash and equivalents. If the inventory 48 has marginally increased to 50, that you can see from 715 coming 838. But it's like you need to again you do some have to do some computations now. How much the absolute term, how much is the percentage kind of thing. But here it's readily shown 49, 51 technically. Right? Maybe 2% increase. So we can ask the client, whoever who is producing these statements, and why this has happened, why you have increased your inventory. Is it a seasonal, it's a special order, so if there are any obsolescence of the stocks, so you can cross check, cross examine the client and get these things clarified before further movement. Why? Because as I was telling you, our sole purpose of analyzing the financial statement is to understand the financial viability of this firm. Whether it's a new company or existing company, we need to understand how good they are in terms of financial stability. If not, then we need to be sure enough how they are going to address these issues. Without knowing some issues, and with knowing these subject to these issues, you may not be able to continue further, pursue further with the project proposal. So that's our understanding, that's our intention is. Okay, so basically when you know these data in terms of common size or horizontal or trend or ratio analysis, now we try to understand the most important, the fourth one, that is the ratio analysis, financial ratios. This is also very important slides, and followed by a couple of slides, because sometimes the examiner would ask about the importance of ratio, what is ratio, why it is important, classification, categorization of ratio, examples for the particular ratio, right, and computation those ratio, and given those ratios, and we are supposed to interpret the ratio, are some of the questions that come to us, right? So initially we try to understand what is this, what are the advantages, what are the typical ratios available for us to further study on some of these ratios, right? They allow us to get a better view of the firm's financial health than just looking at the raw financial statement, right? So remember, I was telling you, the client can say, this is my P&L, balance sheet, cash flow, and then he also, tells you some, data to you. I have done this, I have done, this is my net worth, this is my asset position, right? All good, right? But without going further, without understanding deeper, there's no point in discussing the health of the company in terms of financially. Hence, we try to go into further scanning and then try to understand more on financial ratios. Mainly, we have internal and external users. So internal is basically, let's say you are a company CEO or maybe a higher management, and what exactly you're going to do with your company financial performance. Example, it could be for future planning, right? Let's say you are doing, compared to last year, you are in this position, your turnover, your GP, NP, asset levels, and all that are at a kind of a level. And then based on that, what you can do is you can plan for the future. You can plan for the future. And then based on that, you might say, so we have done you have done sort of understanding about future in terms of sales plan, financing plan, and all those things under planning. Then evaluation of management, like every year, bank also doing these kind of exercises where you try to evaluate the management performances, right? About senior management, about middle management, junior management, using this financial data. That's our internal purposes. Externally, what we can do is, let's say you are a bank, you go through the financial statements and you will take a stock of the performance of the financial position and performance, and then you provide credit to the company because the client can repay debt service cover, interest cover, debt equity ratio are acceptable level. Hence that I am in a position to give some credit. Performance monitoring, maybe it could be financial governance or other. You can monitor the performance externally. Shareholders, tax authorities, banks, other lenders, other creditors can observe the performance of the particular firm by looking at the financial numbers. Right? That's about sales growth. That's about net worth, debt positions, asset growth, or maybe current ratio, quick ratio, like the ratios that you are very much interested, dividend payout ratio. Right? So those are some of the the ratios or the positions, right? Even the cash flow position, working capital position, profitability, ROE, right? So many things that being outsider you can monitor. Now classic example is, now especially in the listed companies in the share market, you can get an idea by going through the financials for the last quarter, year, biannual data. So based on that, sometimes you might do further investments. Then investment decisions, that like to investment in the company, buy out the company, going for the merger with the company, right? Introducing some shareholding. For that also, we are very much interested in the financial ratio outputs. So financial ratios important for both internal as well as external. These are very important ratio categories. Generally, we see liquidity efficiency, leverage and coverage may be as a together, profitability, market valuation. Liquidity of the firm, so one by one we are trying to learn in little while. Efficiency, leverage and coverage, profitability, market valuation. So these ratios are important and is maybe required by different stakeholders also. Especially when you say market valuation, market based information are very much important for investors, stakeholders, shareholders. But some other, it could be important for bankers or maybe tax authorities or maybe even the company stakeholders, right? Or maybe debtor creditor, maybe they suppliers and especially buyers, they might interested in about liquidity and efficiency levels. Like that, there may be separate individuals or the separate interested parties. They are interested in analyzing these ratios. But in general, it is important for us to go through these financial data, financial ratios, because this is basically for examination purposes also. Or if we try to finance a company, so we are very much interested to know that financial feasibility of a particular firm. Right. Any questions up to now before we move to discussion of these things one by one? Any question? Any questions? Hope it's clear, right? I don't think it's like a big sort of change, but kind of some information. But it's very important area, because as I was telling you, there may be some possible examination questions under section B, where we may be asked to write a short note, description, listing, kind of data. Okay. Information.
So,
Yeah.
sir, the common size is using only comparing with the past years, no? Not with the other competitors,
Not
isn't
with the
it?
other competitors. So you try to take a particular financial year, and then you try to, let's say, income statement based on sales, you try to see what are the percentages, and then you do the same thing for the previous year, right? Then you compare the previous year to this year, right? Why you are going to do it? It's an easy way out for you to just understand. Looking at the statement, it's a percentage wise numbers are there. So here 8% last year, 10% this year means we see an improvement. 8% last year, 6% this year means a degradation of, reduction, deterioration from the last year. You can do the same thing by doing across times, last year to this year, but it's a bit of a troublesome exercise where you need to take absolute percentage and all that. So that you also can do. But vertical analysis is much better. It's very easy. You do a common size approach, vertical analysis, year on year, within the company, within the financial statement. Any other questions? Judy, we are taking that financial, the vertical financial or the common size statement for the future, next 2 or 3 computations, so you can have a better understanding when we are trying to do that. Any other questions? Okay. So basically, liquidity ratios. Liquidity ratio is basically something like this. Say a company running its day-to-day working capital, operational activities, they need some financial support. In other words, we talk about working capital. We discussed maybe 3-4 weeks back the importance of working capital, liquidity level of the working capital, liquid level of the firm, gross, net, current, quick are some of the ratios that we interested in learning. So a liquidity in a practical perspective, let's say if you have some money in your purse, not in the bank or not in the fixed deposit, and where you can use that for your day-to-day expenses. If you take a macro perspective, in a company, how best you meet your obligation. your liabilities can be done by converting some of current assets into cash within agreed period, because you can't have everything as cash because it's not advisable. You have some money in cash form in the bank, debtors, prepayments, stocks, so different instruments. But in case if you want to meet your current liabilities, OD interest, OD, short-term liabilities, accrued expenses, creditors, then how best and how soon you can do by optimizing your investments in current assets is the concepts called liquidity. Right? Now, let's say based on that, we are trying to discuss 2 or 3 ratios, which you already know for the time right now: current, quick, and cash ratio. Cash ratio is not very much important because it's just for the reporting purposes we compute, understanding purposes, but not very much in practical tool. But current, quick ratio are very much in use in almost all practical situations. As I told you on the other day, a current ratio is generally it's 1.5 times or more. Quick ratio is 1 time or more in most of the industries. But some other industries, where you don't have that capability, and it depends on the industry. So that's why I was telling you, when you compare the financial ratios with industry data, you need to see where the industry stands. And then you see you are with that below, above. But in general, there are some norms for ratios. 1.5 and 1 for current and quick ratio respectively is such a norm. Hope you understand. Then we see we are going to compute. This is basically, I will rather put this so then you can at least current ratio is current assets divided by current liabilities. If you can go back, I am not sure whether you have that data. If you use the common size balance sheet, and if you take, let's say, here all numbers are relevant to 2010, take current assets figure, take current liability figure, then compute and see what is your current ratio. It's not difficult. Similarly, you can do for 2009, and you can compare what's the number for 2009 to 2010, right? So since we have done this exercise previously also, I'm not taking too much time on this. This is like the answer. 1290 is the current for 2010. EPI is the company. Go to the common size balance sheet and take the current assets and take the current liability. When you divide these two, you get this 2.39 number. If anybody's difficulty in understanding this, let me know, please. Anybody? Were you able to find the current assets and liabilities in the common size balance sheet? Ravin, Udita, Jody, Samindri?
Done, sir.
Done, right? So because numbers are there, just application to the ratio and get the number. Then quick ratio is current assets minus stocks divided by current liability. Can somebody compute and tell us what is the quick ratio? Current assets minus stocks in a 2010 financial year and divided by current liabilities. What would be the number we are getting before looking at the answer? Anybody got the answer? 0.84, Irosha. Udita? Raveen? The same answer you are also getting? 83 point, yes, 84%. Right. See with the others also getting the same answer. Current assets minus stocks divided by current liabilities with respect to 2010. 1290 minus 838 divided by 540 gives a number. So cash ratio again, though that we are not interested, so we can calculate that. See, cash divided by current liabilities. It's basically see how much you have cash in a given time to meet the current liabilities, right? How much cash you have to service the current liabilities in a given time. It's not necessarily to have 100% because it's not very worthwhile, very practical decision, but some percentage of cash to meet any sudden liability request. Right. Okay. Then we move to efficiency ratio. That again, we have discussed this earlier in working capital computation, but it's important. What is that? Not only current assets, this talks about fixed assets also, right? Not only current assets, we need to know the efficiency of fixed assets as well, right? It talks about how well you are using your assets in generating turnover, right? Inventory turnover, account receivable is a debtors turnover, average collection the creditors turnover, fixed assets total asset turnover. What it basically tells you how well you use stocks, how well you manage your debtors, how well you use your creditors, right? I told you on the other day, it's a 3-2-1 in general. 3 months inventory turnover period, 2 months account turnover receivable or the debtors turnover period, 1 month creditors turnover period. This is about ratio, that is about the period. I think when we have periods, you can convert it to the ratio. When you have ratio, 365 divided by particular ratio will give you the number of days. Let's say inventory turnover ratio is 6, then inventory turnover period is 365 divided by 6. Debtors turnover ratio is say 8, then 360 divided by 8 is the debtors turnover period. Creditors turnover period is basically, let's say creditors turnover period is say 8, oh I mean creditors turnover ratio will say 10, 360 divided by 10 will be the period. Either way you can produce this, display this, I mean either way it is correct, but we need to know both ratio period, right? We discussed it in the other day in very detail and working capital computation, but let me know if anybody is having a issue with understanding the ratio and the period, because we have done a couple of questions the other day also. But when you are given the ratio before, I will look into the equations. If you know the ratio, how you could convert to the period is just take 365. That's the number of days per year divided by the ratio. Will give you the period. Right? Okay. Then we try to understand the computations. Inventory turnover ratio. How you are going to compute? Right. Cost of goods sold divided by the inventory. Can anybody tell me the answer? Cost of goods sold divided by the inventory. This is particular for the 2010. Suggest you don't take the averaging because we do computation for 2009 and 2010 as well. Go to 2010, go to the balance sheet, go to the P&L, get the cost of goods sold, go to the balance sheet, under current assets you find the inventory and divide and see what the number is. What could be the answer? So means that you are done with, right? So there won't be any issue on computation, but very good, Ravin, you have done for the both 3.88. So means we have a drop, right, from 2009. Good computation here. Inventory turnover is basically 3250 divided by 838, right? That's for the 2010. We can do the computation for 2009 and see whether increase, decrease, or whether we have improved. Now, in the other terms, when you say the 4 times in the 2009 and 2010 is 3.88 means, are we doing well or are we not doing well? Efficiency level has come down or efficiency levels has increased? Any idea? What do you think? Efficiency levels has increased or decreased? Can anybody suggest? Ravin, මොකද වෙලා තියෙන්නේ? 4 එක 3.8 ට වෙනවා efficiencies. It's a good situation or bad situation?
We are producing more.
Right. Means that what happened to efficiency?
Say, efficiency has grown.
Efficiency has increased or decreased?
Increased.
Right. So you may say 4 is efficiency ratio is 4 in 2009. 3.88 come down in 2010. What could happen there? You can, if you a bit of difficulty in understanding, you can convert and see.
Efficiency has gone down.
Sir, efficiency going down.
Efficiency gone down. So how do you interpret it further? Let's say if you take 4 in 2009 means, what is the stock holding period? Can we compute that? 365 divided by 4. Roughly 91 days. They are keeping stock. Right? When come to 2010, 365 divided by 3.88. 94 days. Marginally increased the stock holding period. So it is not good move in terms of, if you exactly see on the efficiency equation. 90 තියාගන්න එක 94 වෙනවා. 91 තියාගන්න එක 94 වෙනවා. ඒ කියන්නේ with some reason, you know, stock holding period is increased, means extra cost, obsolescence risk. Efficiency has come down. I mean, hope you got understood.
Yes, sir.
Right. So sometimes that we may have to interpret the ratios also. Maybe in terms of ratio, it comes from higher number to lower number. It's a decrease. Efficiency decrease. Period. Higher number come to a lower number. It's a good. Let's say debt collection. Debtor collection period 90 for 2009 per se. Debtor collection period in 2000 say 80. මොකද වෙලා තියෙන්නේ 90 80ට ඇවිල්ලා කියන්නේ data collection efficiency එකක් ඇවිල්ලා තියෙනවා. Somehow they have managed to improve the data collection efficiency. Techniques hari එක එක දේවල් කරලා hari, so they have improved their activity. That's why the number of days from දැන් දවස් 90ක් යනවා නම් මට collect කරන්න මම ඊළඟ අවුරුද්දේ 80කින් මම collect කරා on average. ඒකයි period එකෙන් බලනකොට කරන්නේ. ratio එකෙන් බලනකොට 10 times 8 times වුණා කියලා කියන්නේ deficiency එකක්. 10 times 12 times කරා කියන්නේ efficiency එකක්. Hope you have understood. If anybody is in a difficult to convert this into a number of days, inventory turnover ratio is 3.88. Everybody is in a position to convert this number of days, inventory turnover days, because sometimes we have learned it very well in working capital computation, but if one of you have not been attended, you should be able to compute it here also. Like this is the equation we learned there, but here we learned about both ratio and the period computations. කාට හරි එක තේරෙන්නේ නැද්ද? Inventory turnover, yes, 2010. What could be the inventory turnover period? If anybody can compute, and if whoever who is unable to compute it, grasp the concept, please let me know. Otherwise, we can proceed. 94, yes, Hirosha is the number. If others getting the same number, that is 365 divided by 3.88. If you know the ratio, just go to the number of days per year, divided that by a ratio. Maybe inventory turnover, debtors turnover, creditors turnover, whatever. Then you get the particular period. Stock turnover period or stock residence period, debtors turnover period, debtors period, creditors turnover period, creditors period, whatever we name it, it can get as the number of days period. Okay, right. We continue. Similarly, we can do the account receivable turnover, debtors turnover. That is sales divided by account receivable. So sales is 39, debtor is 402. Then this divided by this give the number 9.70. Right? So let's compute this average collection period. Right? So they have asked to compute it in just for a familiarization. Instead of a ratio, they have asked creditors collection period. So creditors period. This is the equation. Receivables and because the same thing, they wanted to make it as a period. One way it could be average collection ratio and take 360 divide by that, you can get the answer. Or else you can do this exercise. That is account receivable divide by sales and take that number and divide by the 360 divide by that. So in the one step you can do it, or you can do it separately also in this equation, right? If you, let's say if you set aside this 360 and you take account receivable and annual credit sales, it gives you the ratio initially. ඊට පස්සේ මොකද කරන්නේ? මේ ratio එක අරගෙන 360 වලින් බෙදනවා ඒ ratio එක. Give the number. අර අපි කලින් කරපු එකම තමයි. එහෙම නැත්නම් you can use this equation where account receivable divided by annual credit sales divided by 360, which directly give that collection period. Right? Or otherwise, what we have to do is first compute account receivable turnover 9.7 and 365 divided by 9.7 will be the answer. මේක තමයි මෙතන මේ තව චුට්ටක් පැහැදිලි කරලා එක equation එකේ දාලා තියෙන්නේ. I think this is not a kind of the difficult, but for understanding purposes, here a computation is shown how to compute ratio, how to compute period. Hope you got the point. Like that, you can compute asset turnover also, right? Asset turnover, it could be fixed asset turnover, it could be total asset turnover. So basically, in this exercise, it tries to understand how best you are using your asset into generating turnover. How best you are going to use that. That is the equation. Let's say sales to fixed assets, sales to total assets, say 10 times. So means the utilization level of fixed asset in generating turnover in 2010 is 10 times. If you go to say 2009, let's say the answer is 8, then we see a efficiency, increase in utilization. හැබැයි කලින් අවුරුද්දේ 15 තිබිලා මේ අවුරුද්දේ 10 වුණා නම් it's a deficiency. That's what it's telling. So how well you use your asset to generate the turnover. That's a fixed assets. Earlier we spoke about a current asset performance in generating turnover or related turnover related numbers, right? It could be turnover or sales or the extension of sales, cost of sales. ඒ දෙකනේ පාවිච්චි කරේ අපි. Here, sales being used as the one parameter. The other parameter is fixed asset or the total assets. So how will you use the assets to generate turnover is the equation interpretation here. Any questions?
Sir, can you repeat it again?
Right. In case of asset, what we are trying to do is we try to use how well you use companies' fixed assets or total assets in generating turnover. The equation is sales to asset. It could be sales to fixed assets, sales to net assets, sales to total assets. That's the equation. You go to 2009 and you compute that. Suppose you get the answer 9 times. You come to 2010, computed answer, we'll say 11 times. 9 times 2009, 11 times 2010 means you see a increased utilization of assets in generating turnover. That's why the efficiency, increase in the turnover ratio. Vice versa also true. 2009 you get 12 times ratio, 2010 is 10. Means assets are not effectively utilized over 9 to 10 due to various reasons, maybe skill level, maybe inability to get parts or service, or maybe idling of machine. So there may be so many underlying reasons. Good to know, because now let's say the client coming and asking a project financing loan. It's good to know that how his existing business operations are taking place. Let's say the existing machines, especially in the fixed assets, are underutilized. Then the question coming from you is, existing machines also not you are utilizing. Why you asking for the new machine? Why not you use the second look on utilization of existing assets rather than go for a new machine? For example, maybe the requirement is to bring down the imported machine to your factory as a new project to ramp up your production. හැබැයි බලනකොට existing machines වල අපිට තේරෙන මොන හරි අඩුපාඩුවක් තියෙනවා කියලා. අපි ඒක අහලා බලනවා using this equation. Not only current asset performance, we also now understand the fixed asset performance also. පැහැදිලිද? Ravin, is it clear?
Yes, sir.
Right. What about the others? Any questions? All good? Hirosha, Judy, Udita?
Excuse me.
Yeah, Chandi.
Yes, sir. Average collection, when we calculate average collection period, why we put 360?
That is good question, Chandi. Now, generally, we can use 360 or 365. If the examiner has not mentioned, we can use for 360 for the, it's easy to sometimes to get the numbers, divided and get the answer. But if you are using 365, it's ideal. But if you use 360, you can say I am using 360 as a number of days per year. It's an assumption, right? Ideally, 365 is good, but then there may not be any harm, any error, because 365 is the, the best number you have to use. That's a number of days per year. 360 අපි ලේසියට සමහරලාට පාවිච්චි කරනවා, but yes, it's good that you use 365. That's a number of days per year. But computation purposes, computation easiness or explanation purposes, we take 360. Good question, and I think it's clear now. Any other? Okay, let's move. This is the total assets. Yes, nothing new. Instead of fixed assets, you get total assets, right? So sometimes, we can, use multiple ratios, but depending on the context, relevancy, applicability, you can pick and choose what the best ratio that you need to undertake and you need to calculate, right? So otherwise, there may be so many ratios. I have been, giving you so many lecture notes here, so you can read through. There may be one sheet saying number of ratios and how to compute interpretation that has been given, and there may be one case examples that we have undertaken and the interpretation, and there may be take-home assignments for the ABC enterprises. Answers has been given. So just go through when you have free time and get familiarized further on computation, interpretation on these ratios. So then we move to the leverage. This is very important as a bankers, right? This is again a very important ratio in terms of bank. We call this as gearing ratio, leverage, coverage, right? Different terms, but different books use different names, but we'll go by the ratio itself and get an idea. Here, debt ratio, long-term debt ratio, debt to equity, long-term debt to equity are different ratios that we can compute. Especially when you talk about the project financing, we are very much interested to know the long-term debt to equity ratio rather than total debt ratio, because in project financing, we try to finance or we try to provide financing for a longer period, right? So then long-term debt ratio, I mean debt to equity, long-term debt to equity is the most important in terms of project financing, because term financing that we are interested in. But generally, we can compute debt ratio as well, or debt to equity in general also, right? Means that how much a company is indebted with respect to the capital equity provided. Generally, debt to equity ratio or long-term debt to equity ratio should be 60-40. So that is like a norm, right? 60-40, 60% debt, 40% equity. So that is what we are hearing in terms of providing personal financing. We discuss about 1.5 times, right? So like 60-40 is the kind of a norm that sometimes we are using it, right? That basically coming from this debt to equity, like 60% scenario, where we talk about and we confirm that all deduction should not exceed 60%. That is coming from this 60-40 norm. In project financing or other businesses, we say 60-40 could be the ideal debt to equity percentage. But sometimes we see even it has been increased to like 70-80 also, depending on industry. But if it is more or less like very sort of capital intensive industries, we prefer it's below 60. Or it's a startup business, we prefer it's like 50-50 also. It's a new business. Then we ask the sponsor to bring 50% capital contribution from the client, where we give 50% from our side. Okay. You can ask any questions while I am explaining this, right? Here, total debt ratio. Generally, we call this a leverage ratio also. Here, we try to compute asset to liability. Though we call it total debt ratio, it's something leveraging. How much your total liabilities is a part of your assets. So this could be something about liabilities are very high as against the asset. That's a one scenario. Or liabilities to total assets could be very lesser in some other businesses. Example, let's say if you talk about trading business, a liabilities to assets are very high in number. Why? In trading business, liabilities to assets in manufacturing, you sometimes see a lesser number. Why? Because mainly, those assets are funded by equity. Then liabilities to assets show a lesser number. In a trading type equation, most of the liabilities are not like equity funded. Assets are not equity funded. Assets are very minimal. You see a very higher number. Why? If you take go to PETA and they do stocking and selling. Say wholesale traders, if say assets, very minimal, right? 1 or 2, 3 chairs with 1 or 2 fans, right? But majority are current assets, and almost everything are liabilities funded by short-term financing, rather equity. So the assets compared to liabilities are lesser. Then we see higher number because there are lesser fixed assets in trading businesses. Manufacturing, higher fixed assets. When you have higher fixed assets, the total assets number would increase, then debt ratio could come down. In trading businesses, higher fixed assets. Fixed assets are lesser, hence total assets are lesser, hence debt ratio is higher. Just for your information, it's not a very important piece of information, but debt ratio is how much you are leveraging. What is the percentage? What is the relationship between liabilities to assets? Then we go to long-term debt ratio. That is again, we see long-term debt to total assets. That's another important information. We are debt level versus asset, another leveraging. So the gearing actually. Gearing is basically debt to equity. Leveraging is something about debt to asset. Debt to asset, liability to asset. Earlier, when you say liability, it includes both current, long-term liability, both, including creditors. But here, you try to understand long-term debt to asset. It again tells you how much your assets been funded by long-term debt. In this equation, it's 25. Means the rest 75 is funded by the equity. Again, it depends on industry to industry. Right? If it's a manufacturing organization, this is the ideal scenario where majority of assets being funded by the equity, not the debt. It's a trading organization. This is not the equation where not total assets, very limited could be the assets, and then this number could be increased because debt is not going to change, but asset is going to change because majority is the current asset. Like that, there may be several equations. You can do computation, but you shouldn't be very much worried because these are not exactly relevant in across all businesses. But debt to, liabilities to assets very important equation, that is total liability to total assets. Will tell you how much leverage you are. And if you want, you can compute long-term debt, short-term debt, total debt to assets also, but it doesn't give a kind of a very unique picture because it depends on industry to industry. Trading organization, service organization, manufacturing organization, then it gets different interpretation. But if you want, you can compute. The beauty here is you can compute year on year and then you can see the trend. For that purpose, we have this equation, but for exam or other purposes, we don't see much of relevance on these. This is important, especially debt to equity, where again liabilities to equity is the equation here. Total liability to total equity. When you say total liability, it includes both current and long term. Right? Again, we can further improve this equation, that is total debt to equity. That is most relevant. Because why? Liabilities could be creditors also. But creditors, we assume, being funded by assets. Because the creditors are there. When you realize current assets, the creditors could be settled. Hence, we are not very much interested about setting off the creditors. But long-term debt, short-term debt are important for the equity because the capital introduced by the client is responsible to service the debts the company obtained. It could be long-term, it could be short-term. Especially long-term, important if it is a project financing entity. Other entities, both long-term and short-term, are important. But as I told you in the beginning, project financing, we are very much interested in long-term debt to equity. Why? We plan to give long-term debt to project financing ventures. Instead of worrying about short-term debt, we try to know what is the company position long-term debt to equity. Right? So why that we are not worrying about short-term debt? Again, we assume short-term debt has been taken to finance current assets. Right? OD, short-term loan, being taken to finance current assets. Hence, we assume realizing of the current assets, cash, bank, debtors, stocks, will solve your problem by settling the short-term debts whenever it is due. But long-term debt, it is not so. Long-term debt to be serviced through company cash flow. You have a higher pressure on servicing the long-term debt. Hence, equity to be there to safeguard the long-term debt. Right? As I was telling you in the beginning, there may be so many ratios, but only one or two ratios are important for project financing. What is the ratio? That is debt to equity. When you say debt to equity, ideally, long-term debt to equity is the most important equation for us. But debt to equity can be computed liabilities to equity. It's good to have it. Here, liabilities includes both long-term and short-term. But debt to equity, long-term debt to equity is the most important equation, where you try to take long-term debt into the equation. This is the equation here. This is 61%, right? If you see this, this is something 1.140%. When you
Excuse me,
say,
sir.
yeah,
What are the things carries under long-term debt there? If it's mentioned over the financial statements, or
yes, in the financial statement, it's a long-term debt and the short-term debt separately. Long-term debt is basically long-term loans you obtain from the bank. Current under current liabilities, you have some short-term debt, OD and all that, which come the short-term debt. But when you say total liabilities here, irrespective of debt, we have taken all liabilities and see whether how it will be impacted with equity. But ideal scenario is what we are interested in is this one. When you say debt to equity, it is long-term debt to equity we need to know. That is long-term debt divided by total equity. Equity is basically capital or net worth, retained reserves, and the profit for the year. That's what generally equity component is. It's there in the balance sheet. Long-term debt is basically the term loans you obtain to finance the fixed assets of the company. It's a long-term debt component. Sometimes we might use the debentures also here, preference shares also here, but when you say long-term debt, we will disregard that and take on the debt component which used to finance the assets of the company. When you say assets, it's only the fixed assets, not the current assets, because we assume current assets being funded under short-term debt. But if you're interested, you can take total debt into this equation also. That is long-term debt and the short-term debt. Then this percentage could be something about not 61%. It could maybe further down. It could be because when you introduce another 100 or 200 billion as a short-term debt, so this could be something about 90% or so. Then it says a very high number. Why? Because short-term liabilities also included. But we are not worried about that. Just to summarize here. Yeah. Any questions before?
If in 2009,
Yeah.
debt to equity ratio is long-term debt to equity ratio is 48.75,
Right.
and this year is 61.90. It
Right.
means that the coverage from equity to debt or something like that.
I didn't hear the last part. Coverage.
Coverage from equity to debt.
Yes.
Is it something like that?
That's it. Basically, it says now 2009 it is 48. 2000 it's 62 means one interpretation is the company has taken more debts compared to 9 to 10. Ideally, we need to look at see what exactly the change of the equity and change of the debt. But generally, ratio is improved or deteriorated. It is deteriorated because 50% is something, debt to equity 50-50. In a given time, you are trying to manage your debt position to equity position is 50-50. It's good to you. When you say 60 is debt. The debt component is increased by 10%. And the equity technically come down to 10%, 50 to 40. So you have a high risk now because higher debt component, because you need to service that through capital, through interest. That's what he said, the gearing has increased from 9 to 10. If it is other way around, 50% 2009, 40% 2010 mean company has serviced or settled most of its long-term debt. It's a good position. They are good in managing the financial commitments. That's how you interpret from year on year, right? Just want to tell you here, we are trying to understand the leverage and coverage. Or leverage is basically part 2, leverage, and within that we can also understand the gearing. Gearing is very much important for us. Gearing is basically debt to equity. When you say debt to equity, it could be total debt to equity, long-term debt to equity, short-term debt to equity. Only you take debt part, compare with the equity. That's the gearing. But in project financing, though we have 3 ratios, total debt, long-term debt, short-term debt, we are very much interested in computing and interpreting long-term debt to equity. Why? In project financing, we are financing a majority of our components, loan components are long-term in nature. That's one. Why we are not worried about short-term debt to equity or total debt to equity? Because we assume short-term debt are taken to finance current assets in the firm or working capital in the firm. When realizing the working capital, this short-term debt being settled. So we are not very much worried about short-term debt liabilities in a firm. So that's why we worry about long-term debt to equity in understanding the project financing. One. Number two, leverage is how well the company is managing its asset and liabilities. That is, a liability is to assets. It's the leveraging. So you have assets and you have some liabilities. So if you see that your majority of assets being funded by equity, then what happens is you are highly leveraged. Sorry, you are under leveraged. You are what do you, the exact word is, you are under leveraged because this is the, let's say example, assets is 100 being funded by 75 by equity, 25 by liabilities. Then what happened? So 25 divided by asset, 100 is 25% because 75 is funded through equity. If it's the other way around, 100 is the asset, 75 is liabilities, where 25 is the equity. Low equity in terms of assets. Then you had a higher number in the leveraging figure. Depending on the industries, you see highly leveraged and the lower leverage companies. You can't say this is good, this is bad. It depends on the industry. Because especially in the manufacturing organizations, assets are being majorly funded by equity because the high risk, long-term nature of the assets, building, machinery and all that is required to fund by equity. Otherwise, it's a risky. But in terms of trading organizations, there are not so much assets other than the current assets. Being equity is coming and playing a major role. Trading organization leverage ratios are different to manufacturing organizations. So you shouldn't be much worried about the number, but you need to understand the industry dynamics. So the leverage ratio is the representation of the liabilities with the company assets. The gearing ratio is the representation of the debt to equity. Bankers, we are very much interested to know gearing ratio. Leverage is also important. How best that they are using the assets to make the company businesses. How much leverage is important in terms of efficiency. But debt equity ratio is important in terms of gearing. Highly geared or not is a question the banker would see before financing. That's why sometimes in a personal level, when you go to company, take a personal loan, they might say your debt equity, DSR is not adequate. Means they are not financial discipline or they have overborrowed. We are not happy. Similar with the entities. If the debt equity is 70, 80, probably we may say you're highly geared. We are unable to finance because there's a higher debt component, resulting higher interest component. So we may not be in a position to accept you at a given debt level. How we are going to compute is debt to equity. It could be long-term, short-term, or total debt. Either way, or you can compare with the previous years and see whether what is my total debt to equity ratio, what is my short-term debt to ratio, what is my long-term debt to equity ratio. Most important ratio for us is to long-term debt to equity, which is like 60-40 as an industry norm in terms of project financing. Any questions?
Sir, excuse, the
Yeah.
leverage is the debt to equity, no? Isn't it?
Now, leverage is like liabilities to asset. Gearing is debt to equity. So we call it as a debt
Although,
to,
all
yeah.
those, when we ask to have a leverage ratio, it should be the debt to equity. So for the gearing is comes under leverage again.
Yes, leverage, the gearing is part of the gearing is part of the leverage ratio, right? But in some textbooks that we have segregated as gearing and leverage, gearing is specifically the debt to equity, which we are very much interested in. Leverage is like asset to liability, debt to liability. That's the kind of information or the equations we get it. So leveraging could be total liabilities to total debt, total liabilities to total assets. That's a leveraging. When come to the gearing, we specifically pick and choose the debt component within the liabilities and compare with the equity. The debt in the sense debt with the bank, for example. When you say liability, it includes creditors and other liabilities also, not only the debt. Is it clear, Chandi?
No, I asked what, sir.
Rachel,
Yes,
sorry.
yes.
Okay. Any other questions? Right. Now we try to move coverage. This is again important three ratios where actually two ratios: interest earn, debt service cover. Because in general, after the debt equity, we interested to know how well the client can service the debt he has obtained, he is to be obtained, right? When you say interest cover, interest earn ratio is how well the client is able to service the interest on year, and the debt service cover is how well the client is in a position to service the interest and capital both. Those are the two ratios that you interested in. Then computing the interest earn ratio, it is this one: earning before interest and tax divided by interest expenses. Actually, in most of the textbooks, though it is mentioned like this, that is earning before interest, tax or depreciation divided by the interest expenses, or rather operating profit divided by interest a particular year. In Sri Lanka for IBSL exams, we try to compute this after deducting tax, right? EBIT, yes, we need to take the figure as it is, but after deducting tax, we try to compute interest cover ratio, right? Textbooks say earnings before interest and tax, but in Sri Lankan context, we use earning before interest, but after tax. Keep that in mind. In case if the examiner wanted us to compute, make sure to deduct tax before arriving the profit figure. Before arriving the profit figure, you need to remove the tax component. Then no change to the others, right? So for this example, they take EBIT for the 2010 divided by interest expense, that we can get the number.
So that means earnings before interest, but after tax, is it?
Yes. Ideally, it is earning before interest, tax, and even depreciation or amortization. But here, anyway, earnings before interest, depreciation has been taken. Depreciation anyway is not a cash element. But here, tax also deducted. Tax also been not deducted as per this equation. But for us, IBSL, we treat tax is a mandatory. We need to deduct it before computing the interest expense. That was a practice during the last 5-10 years. So hence what we try to do is we try to deduct tax, get the figure divided by the interest. Then you can get the interest earn or ratio or interest cover ratio. Any ambiguity here? When you are trying to compute it, you also can make that assumption and do your computation. It's because now general practice it's not that, but since that IBSL all suggested answers and everything is coming in that form, so we need to align with that. No harm. It's good that if you can pay off your tax and see what the interest earn is better. But in general, acceptance is interest is like tax deductible, no? So after paying tax, the tax component is very much further coming down, right? So the computation is done accordingly. But when come to the equation, they want tax component deducted before getting the interest cover. So means that whatever possibility you need to pay tax, no, whether you pay interest or not, tax is mandatory. So if you are tax eligible to pay, you have to do that. So we have taken that into also account in arriving the equation.
So this interest earn ratio means interest cover, right?
Interest cover, yeah. In other words, it's interest cover. This textbook is given the times interest earn. It's an interest cover ratio because it's important. In most occasions, the clients are servicing interest in terms of leasing, ODs, STLs, and all that, right? In the term loan also. So this gives the understanding where the client is in a position to service the interest only. In general, we prefer it is more than 2 times. Okay, generally it is 2 or more, we say it's good. Now we try to understand another ratio, though here we don't have the data to compute. This is not relevant, you can just refer this one. This is a debt service cover ratio. Here again, we take profit before interest and depreciation, even after tax again, or net profit we mention, but ideally it is profit before interest and depreciation and even before tax. But in Sri Lankan context, we reduce tax, but we keep interest and depreciation not deducted, divided by capital and interest. Earlier, same equation is divided by interest only. Then we call it interest cover. Here, instead of interest, we introduce the capital payment also. Then we call debt service cover ratio. Now, keep in mind, here we take interest components, capital component for the particular year. Okay, for the particular year, we keep capital and interest. Going through the cash flow, we are in a position to understand that what is the capital, what is the interest for the particular year. So, profit before interest and depreciation or net profit divided by capital and interest. It gives you the debt service cover ratio. Generally, we need cash flow statements to get those figures. Otherwise, P&L and balance sheet, yes, through indirectly you can get that figures, but ideally, you need capital and interest figure through the cash flow statement. Right. Any questions on this equation? Right. Again, I'm not also discussing with this. This is again nice to have ratio, which we are not basically using many times, but just pass through this. No worries about for the the computation. But in very high level analysis, we can use this type of equations, but not for general SME corporate type of clients. This is a bit of important again, profitability, which is very much common to us, where we try to understand the profitability of the firm. And also we try to couple with some investment related information ratios here, that is return on equity and return on assets, or return on investment, return on equity. So when you talk about profitability ratio, we are talking about GP, OP, NP, gross profit margin, operating profit margin, net profit margin, right? So that is operating profit divided by sales, GP divided by sales, NP divided by sales will give you the answer. How much profitable this organization is. When you compute for year on year, you can say from year 1 to year 2 to year 3, whether GP ratio has been increasing, OP ratio has been increasing, NP ratio has been increasing or deteriorating, which gives the understanding of how profitable. Because this is anyway very simple to understand, rather than going to the cash flows and further analysis. This gives you understanding whether you are making profits or not. Cash flow is a different thing, loan repayment is different thing, but this gives you understanding. Yes, I am profitable during last couple of years. I am continuously increasing my GP ratio, which tells you the efficiency levels. I am maintaining a good so OP ratio means that I'm managing the other expenses, general expenses, some impression. For that, it's good to know the profitability ratio. Computation is not that difficult, just to GP sales. You can try it for 2009-10, OP, net operating sales, NP, income to sales, net profit to sales. That's how it basically computing 9 and 10. Even you can see these numbers in the common size balance sheets, so automatically calculated because we have taken the sales as your base. As a percentage, this has been computed automatically, computed there. Then these two, ROA is where net income to asset, return on assets, return on investment. This is important, not only the company stakeholders, but outsiders. As I was telling, some investor ratios. Though this is not exactly linked with the share market, maybe going through the balance sheet, going through the P&L, you can get an idea where how well the company is performing in terms of assets to income, equity to income. Now, recent past, we hear in banking sector, return on equity has been increased from 11 to 12% on average to 14, 15 to 16%. Means investors who want to invest on banking stocks, banking sector, will see this equation. In generally, in bank, return to asset, return on investment is something, return on asset is something 2% or 1.5%. Very low number. It's across similar to the banking because higher assets are put here to get this income. But equity, return on equity, net profit to equity is now, as I just told, increased to 15% or so. It's a very good achievement, overall banking industry. Then the investors would prefer to come to banking stocks, banking sector investment from the manufacturing to other investment options, right? So return on assets, return on equity, that is about profit to equity. This is something 11% with respect to this company. So this is a figure where many investors prefer. So this again another equation, but we should not very much worry. But ROE and ROI or ROA is very much important because that gives you understanding about the investors' perception towards a company. These are another two equations where market valuation, market performance, market-based ratios. Not all companies are listed in the stock market, but some companies are invested or listed in the company, in the stock market, which gives you a different perspective, who are deciding on investing on the company shares in the stock market. PE ratio, price book ratio, earnings per share, dividend yield. There are several ratios that you can find it out. We are not going to do all those things computed here because we don't have the data. But if you go to stock market and if you download the company quarterly or annual financial statement, you can find these ratios computed. Earnings per ratio, price earning ratio, price to book ratio, net book value are important. That's why sometimes when you are looking at the kind of analysis on the company performance, in the stock market perspective, they might tell us, the price earning ratio of this company for the last 4-5 years is like this, net book value is like this, market capitalization is like this, there's a room for growth. So that is basically a stock performance related ratio, stock related language. That is also good if the particular company is listed in the stock market. Similarly, if the particular company listed in the stock market and come into you take a project loan, it's good for you to analyze their market performance about dividend yield, dividend payout, price earning ratio, market capitalization, right? About liquidity, illiquid or liquid share, important, because how the investors perceive, how much the fundamentals are strong here. There may be, a market perception could be different, right? That is also important for us in taking a collective decision about the financial performance. But majority of SME to corporate to mid-market clients are not listed. Hence, we are not very much worried about market performance ratio. And given their financial, we are not in a position to compute the market performance or analyze the market performance ratios. Right. So today what we have been doing so far is to understand a company financial statements and analysis of the same. There we discuss what are those statements, importance of those statements, components of statements, type of tools to analyze financial statements, and then ratio analysis. A type of ratios, under each ratio identified a couple of important ratios, how to compute and interpret. Right? So since the time is going to lapse, so we will stop for today's lecture. We'll continue. There may be a couple of slides to continue, and we will continue with the next session as a part of a continuation. And one more announcement. We are yet to finalize the date for the exams. However, if your friends have not yet applied for the examinations, ask them to apply, and through online could be considered under late payment, but still they haven't finalized the late entries also. If somebody is interested in applying again, because now since the examination may not be possible in October, could go well beyond that October and maybe end November also. So they also have adequate time to prepare the exam. So let others also, inform that, apply under the late entry category through online. Right. So any other questions?
So under the debt equity ratio, the efficiency level of the equity is 40% and the debt is 60%, isn't it, sir?
That's right. Debt to equity 60-40 is, debt is 60, equity is 40. Altogether it's 100.
Sir, but if in case the company goes bankruptcy, that time, how the company can manage the debt with having this 40% of the equity, sir?
Means that the equity is only 40, no? Debt is 60. There may be other assets also there. You know that the 60-40 is the debt equity, right? And that 100 is the liability side, right? Then asset side is basically that 100 is basically funded. I mean, using that 100, you have funded your total asset base, which include maybe long-term assets and the short-term assets as well. But if the nothing, value addition or nothing happen, then whatever when realization of that assets, first go to liquidate to settle that 60%. Then you are not have anything as equity, as a last resort. But if say you have some assets with value and all that, then you sell it at the market value, then you have some surplus. Or even at say realization assets say 80 rupees, but first you settle 60, 20 for the shareholders. That is why it's a costly, equity is costly because you are the last resort. You can't get anything more. Because you've been paid as a last payment holder. So equity is risky. If company is doing well, they can get more. In case of liquidity, if the asset value are not adequate, first settle all creditors, including long-term, short-term, and all that. Then debentures, then preference shareholders, then go to the equity shareholders, ordinary shareholders. You are at the losing end. That's how it operates. So we presume this ongoing basis, going concern basis, 60-40 is like, adequate to run the business. In a case of liquidation, you need to think about the value addition of the assets. Sometimes maybe 100, 60-40 together you funded assets, but over a period of time, there may be assets you can sell it at a higher value, not the book value. Let's say you take a machine, for example, vehicle, you purchase for about 5 million, but the market value could be 10 million. The surplus 5 million could be for the betterment of the shareholders in case of liquidation, or vice versa could happen. 5 million the book value, but only your selling value could be 2 million. 3 million loss again has to be either bank or either equity. But not initially bank get the impact because they are priority settlements. Ultimate result could be the shareholders. Is it clear, Judy?
Thank you, sir.
Okay. So then thank you very much for joining me today. So stay safe as I'm telling always. So we'll meet next week, 8 o'clock. So we'll continue with the rest of the presentation plus a new session in next week. Thank you.